Hello, everyone. Welcome back to another episode. I'm your host, the Millennial Investor, and today what we're going over is how to get started investing with little to no money. So, what I did, I went ahead and linked this article right here. You can go ahead and search this yourself and read this article yourself. Just search how to build a dividend portfolio by Simply Safe Dividends. This is a great service, and I think that this article wraps it up pretty well. And they have some different points that I didn't touch on, and I won't be going over this article in this video because that's not what this is about. I am going over my personal reasons, but if you wanted to see an article for yourself, this is a good place to get started. This video primarily targets those that are brand new to investing or looking to get started, and if you're wanting to get started with a brokerage, before we go over all these reasons that I just listed here in this little email that we can go through here, if you're wanting to get started, one of the ways that you can do that and how you can help support me and my channel is you can use this link right here. M1 Finance is the brokerage that I use. It is absolutely free to get started. And if you're watching this, now is the best time to do it because usually you only get $10 for getting signed up. Right now it is double that. You get $20 just for downloading the link, signing up, and depositing $100 to the platform. So if you want to use M1 Finance, it's free. And if you want to see my investments, this link is also in the description as well as the referral link. And if you want to just see it right now, here are the 27 stocks that I own. You can pause the video if you want to see it at any time. And there you go. There's all my 27 investments. But if you want to go ahead and follow along like me, if you want to follow along with me in my journey and you want to track your annual dividend income, your monthly dividend income, your portfolio value, your monthly YouTube income, all that stuff, go ahead and subscribe to the channel. I'd invite you to do that so you can follow along with me in my journey. And there's my YouTube income broke down by category. But I disclose everything, guys, so let's go ahead and get started. And how do you get started investing with just $100? That's all that you need to get started with M1 Finance. Now, if you are watching this and you don't have a lot of money, if you only have a couple $100 to your name, $1,000, whatever, I started this portfolio with $1,500 back on April 3rd. Now, since then, I've steadily grown the portfolio. I'll track my mouse along the screen here as I go along. Then I got it up to 2,000. Then I got it up to 2.5. Then I got it up to 3,000. And then I got it up to 3,500. Then I got it up to 4,000, 4.5, 5, and now I'm over 5,000. Now, of that $5,058.91, I have deposited $4,200. So basically, you're looking at about $860 worth of gains. That's between dividends and referrals and stock price gains. And this number right here doesn't even give you the full picture. This doesn't count stocks that I've sold for profit, all that stuff like that. So how did I do that? I'm not doing any kind of crazy investing where I got super lucky. You know, you see a lot of videos if you're brand new. You probably see a lot of people like investing in Tesla, right? The stock has went up 1,000,000% in the last year. So you see stocks like Apple. Apple has thrived in this recession. They went sky high prices. A lot of these people are investing in the same old growth stocks. And there's nothing wrong with that, but I'm a dividend investor. And hopefully if you follow along with me, you'll be a dividend investor as well. And I'll give you my reasons for that. So why do I invest in dividend stocks rather than these blue chip stocks like Amazon, Apple, Tesla, stuff like that? Well, if we go back here to my email, I'm going to go ahead and get started with my number one reasons for investing before we get into any kind of strategy. So before you define a strategy, if you want to invest in growth stocks, you want to invest in dividend stocks, no matter what you need to do, these 8 rules apply regardless. It doesn't matter what you're investing in, you need to know these. The first one is only invest for the long term. As you know, stock prices can do anything in the short term. So let's go ahead and give that example with Tesla. That's a perfect example. Imagine last year if you invested in Tesla for $50 a share, and then it goes up and up and up, and then it goes to $177, $180 a share, right? It's a huge gain on your part. That's like triple your money. Now, if you would have held on to that stock and you would have saw this drop all the way back down to 70, you would have lost virtually all your gains in about a month and a half. So if that happened, you probably would have been freaking out. Now, if you would have held on to that, you can see how that's worked out now. While it crashed down to $72 a share, it's now in the 300s, and at one point it was even in the 500s. Now the same thing goes for that with pretty much any stock. And if you search SPY here, this is the entire market. This is the S&P 500. This went from $338 a share all the way down to about $220. So that is an insanely high drop. And if you're panicking selling right here, this is not what you should be doing. You should not be investing. You should be investing for the long term. And this is a perfect example why. If you sold out here, look what the market has done since then. Right back to all-time highs. So you would have got all your money back and probably even then some. Do not trade. This goes hand in hand with long-term investing. Number 2, do not trade. If there was any one of these number 8 rules that I had to recommend for you, if you could only take away one of these 8, if I could only tell you one rule, it is number 2. Do not trade. Do not do short-term movements. Do not listen to anybody's opinions on technical analysis or swing trading or short-term movements. Short-term trading, day trading, anything of the sort, options is not anything you want to mess with. You want to focus on investing, not trading. If you invest for the long term, you can see how that works out. But if you're buying here and then selling here, or if you're buying here and then selling here, you're always going to get at a loss, and trading is almost unprofitable for over 90% of average investors. Number 3, invest in things you understand. So if you go back here to my list, you'll see a lot of stocks that you probably recognize by name. Maybe you have a Visa credit or debit card. Maybe your electricity is provided by the Southern Company. 3M, I guarantee nearly 90% of the people watching this use it every single day and probably don't even realize it from their 56,000 products. Caterpillar with common bulldozers and industrial equipment. Maybe JP Morgan Chase is your bank. Pepsi. Maybe you're drinking a Pepsi right now or eating Cheetos, Doritos, Fritos, drinking Gatorade, whatever the case may be. Johnson & Johnson Healthcare. You get the point. A lot of these companies are basic household names that you use every single day, and I'm sure you probably recognize at least half the names on the list or have used one of their products at some point. Now with these stocks, I understand the basics of their business models to all 27 of these stocks that I currently own. I understand what their business is doing, I understand if they're having positive or negative results, and I understand their long-term trends for their categories. Now I am not investing in every single industry. Now for example, I want to give an example. AbbVie. AbbVie is a stock that a lot of dividend investors like to invest in. It's one that you probably think I would be investing in. They have a great yield, they have great financials, they have a great track record, and their stock price has done okay over the last 5 years. Why do I not invest in them, you might be wondering? I do not understand the business. I do not understand pharmaceuticals. It's okay. That's not everybody. Some people understand pharmaceuticals. That's just not me. I don't really understand how their business model works very good, and I don't really understand the products that they sell and how big of the moat that they have behind their business. So overall, I'm just not going to invest in many pharmaceuticals, which is why I only own one healthcare company, which is the best and brightest, Johnson & Johnson. You can't go wrong with Johnson & Johnson. But other than that, I only invest in companies I understand and do not invest in a company that you do not understand, because when that company has a downturn or when it goes sky high in price, you will not know how to value it because you do not fully understand their business model. Number 4, be conservative. Be conservative is something that I see a lot of people not do when they get started. So like I said, we'll just use Amazon for an example. If you love Amazon, if you love their products, I think Amazon is a pretty great investment. I would not doubt anyone that wants to invest in Amazon. No issues with that. But does that mean that you should dump your entire life savings into Amazon? Probably not. Now, I made a video on my last episode called Nikola, a scam. Nikola is a stock that has had a lot of people convinced that it was going sky high prices. In 2 days, it went from $36 a share up to $80. Now it's $18. So if you're investing all of your money into one stock, if you're not being conservative, even if it's a safe, awesome company like Amazon, you can't predict what's going to happen to Amazon in the future. And one piece of information that I might keep in mind for you, go ahead and do a Google search if you're brand new. Go ahead and search Enron stock back during the Great Recession. Enron was a company that was one of the largest companies on earth, and it went to zero practically overnight. So you never know, maybe there's companies having fraudulent information, maybe they are reporting earnings that are not actually legit, and the SEC could even take them down or fine them heavily, or maybe even remove them from the New York Stock Exchange. Whatever the case may be, I'm not saying that's happening with Amazon, but you never know, and that's why you never put all your eggs in one basket. And that's why I have a lot of safe stocks like Pepsi and Coca-Cola, Johnson & Johnson, JP Morgan, I'm never going to invest all my money into just one of them because that would be ridiculous. Number 5 is do your due diligence. So number 5 is one that is very important. Just do some basic research about the company. And when I say basic research about the company, I don't just mean their products. So I'm sure a lot of you all know Coca-Cola. Coca-Cola is one that is very simple, very basic, and it doesn't require a lot of research. One thing that you could just look up their balance sheet. Look up their investor relations page. Look up where they're looking to grow in the future. Where are the categories that they're looking to expand their business? Where are categories where they're looking to reduce them? Just basic things like that. Look up their CEO. Just some basic information about the company. You would be amazed how many people invest in basic companies every single day and don't even know those basic things like their CEO, their business plan, things like that. Number 6, do not over leverage. Now, this goes hand in hand with number 4, being conservative. Now, when I say do not over leverage, that also applies to investing all your money in one stock, like the Amazon example that we gave. But that also means do not invest money you cannot afford to lose. Do not max out your credit cards to invest. Do not take out loans for incredibly high interest rates to invest. If you have to take out a credit card loan that's 25% interest, you have to get a 25% return just to break even. So that doesn't really make sense. So investing over leverage most of the time does not make sense. And that goes hand in hand once again with number 7. Invest money you do not need for years. So I want to give the example with the S&P, where pretty much all stocks went down earlier this year in 2020, in March of 2020 when everything hit their lows. Now if we click the year chart here, imagine if you're investing, everything's going good, and what happened during the middle of the year, the beginning of the year, around March time? People were losing their jobs like crazy. So imagine if you lost your job and you now have $0 in savings, right? So now you have to sell your investments just to be able to pay your bills. Well, if you had some cash on the side, you wouldn't have to sell your investments. You could just use your savings. That way you could keep your investments. Now, if you were forced to sell your investments right around here, you'd be selling for a 20, 25, 30, 35% lower rate than what you could have just 2 months ago. So if you're investing and you're having to sell your investments when things go down, that is the worst thing that could possibly happen. So always have at least a little bit of cash on the side, and that is when I see number 8 right here. And even if you're not wanting to keep physical cash on the side, there's a couple different opportunities that you could do. You can search long-term treasury bonds, like investing in stocks like EDV. It's an ETF that holds long-term treasuries, much more safe. Or you could do things like invest in SHV, which is just short-term treasury bills, which is pretty much like a savings account. It stays within about a 1% range, and you'll get about a 1.23% dividend yield just for holding it. And that is basically the equivalent of cash, can be sold and converted into cash pretty much overnight. Now, let's go ahead and go to individual stocks or ETF. I'm going to just go through lightning round, go over these number 8 reasons, and this is why you should pick either individual stocks or ETFs. I'm trying to not be biased, even though individual stocks are the ones that I like to do. These are the 8 reasons that I think is most important for investing in either one. Individual stocks require more research and time. Now, obviously, an ETF is much more diversified. The S&P 500 is just the basic market average. If you're investing in SPY, you're going to get market average returns. Now, in the example I gave, even with a simple business model like Coca-Cola, you have to pay attention to what Coca-Cola is doing. While America might be doing great, Coca-Cola might have some issues. Maybe they have some production issues, maybe their branding, their company, their CEO, whatever the case may be. You have to have more time and research into individual stocks. Number 2, ETFs are very set it and forget it investments. And the same thing going hand in hand with number 1, Coca-Cola, you have to pay attention to what's going on. When you're owning SPY, when you're owning the top 500 companies in the world, even if Coca-Cola has a downturn, that's okay because it is less than 1% of your investments. You still have 499 other stocks that you own, and Coca-Cola does not make up a big portion. So it doesn't really matter all that much. It is a very set it and forget it type investment. You can throw some money in it, fall asleep for 10 years, and you're going to be perfectly fine. Number 3, most people are not disciplined enough for individual stocks. I think a lot of people get manipulated by fear and stuff. When you start seeing companies like JP Morgan, very strong, financially healthy company, is very unlikely to go bankrupt anytime soon. But a lot of people see the stock go down in price when they see it go from $130 a share down to $80, and they want to sell because they're scared. And that's understandable, and that might happen if you're owning individual stocks. But if we go here to number 4, ETFs are better for most beginners because it is a lot safer investment psychologically. If you're looking at one stock price and you see that it only went down 1, you own all these companies and you're a lot less prone to sell than if you own individual stocks that might be performing much better or much worse in a recession. But overall, guys, if you're wanting to invest, most of you watching, if you've never invested before and you're just starting with $100, ETFs is usually the way to go. And the stock that I would recommend for investing in that is either SPY or VEO, which is basically just the S&P 500. Very basic, very simple. Number 5, individual stocks give you much more control over your money with no fees. Now, when you invest in the stock, if you're wanting to use M1 Finance, once again, link in the description, $20 just for signing up. If you're wanting to invest in these individual stocks, let's say you want to invest in Pepsi, it is absolutely free to invest. No fees whatsoever. You do not get charged anything to invest, right? But if you're investing in an ETF, there's very small fees that are associated with it. And that goes hand in hand with the next one, the comparison to individual stocks. ETFs provide an easy source of diversification before a small fee. Now, like I said, if you're wanting to invest in a multitude of stocks, VOO puts your money into 500 different companies. Microsoft, Apple, Amazon, Google, Facebook, Pepsi, Coca-Cola, Broadcom, Realty Income, whatever the case may be, you're investing in hundreds of different stocks, and the only thing you get charged is 0.03%, right? So let's go ahead and take our calculator out here. So let's say you're investing $1,000. So for every $1,000 you invest, you'll be getting charged 30 cents a year in fees. Not very bad. If you invest $10,000 a year, you're looking at $3 a year is what this is going to cost you to invest. Practically nothing. So you will get charged some fees, but as long as you're investing in ETFs that do not have a high expense ratio, you'll be just fine. And this is why I recommend VO for investing. Number 7, do not chase dividend yield. If we go to Research tab here, we click Stocks, and then we sort by dividend yield, highest to lowest. You'll notice a trend here. Look at this 5-year chart, down significantly. Okay, let's go to the next one. Let's go back. Let's click the next one. 5-year chart, down significantly. What about the next one? 5-year chart, down significantly. The reason is, the higher the dividend yield, the more unsafe a stock is. But if you're investing in very blue chip stocks, like a Pepsi or a Coca-Cola, JP Morgan, they're very safe and they're going to be great for the long term. Do not invest in companies that have extremely high dividend yields, because usually if you're investing in companies like ExxonMobil, for example, that have dying industries, that have great dividend yields of 10%, but look at their stock price over the last 5 years. That's exactly the point I'm trying to make in a situation like this. Number 8, only choose ETFs with reasonable expense ratios. I won't go over that too much, but basically that's why I say choose VO over SPY. Both these are great, but a 0.09% is where you're getting charged with SPY, and then with VO you're only getting charged a third of that at 0.03%. Only choose any ETFs in general which have small fees, which is why I don't like ETFs that have expense ratios like SPHD that are 0.3%, 10 times higher than that of VOO. Now let's go to define your strategy. You got your strategy picked out. You're either investing in ETFs or you're investing in individual stocks. You know your 8 rules. You follow it along. You're being conservative, doing your research, not over leveraging, being invested for the long term, not panic selling. And then last but not least, let's go ahead and get to dividend investing or growth investing. Now there's a number of investing strategies out there, but these two are the primary investing strategies. You're either a dividend investor or you're a growth investor, generally speaking. Dividend stocks are more conservative, generally speaking, and growth stocks can provide a much larger return. Now, when we look at Coca-Cola, it's just a simple fact that they're such an old blue chip stock that nearly all of the world already drinks their products. They're not going to grow massively. Their stock price is just going to slowly trend up, but it's one of the safest investments you can do. They'll pay you dividends, their share price will go up, and then a multitude of things will happen, which will be positive for the company in the long run. Now, when you look at growth stocks, they can provide much larger returns. Now, let's go ahead and look at NVIDIA. That is one that has provided very large returns over the last 5 years. I mean, look at this share price growth. Just 5 years ago, this was a $20 stock. Now it's $500. If you invested in the stock 5 years ago, you would be very, 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 very happy with your returns. But dividend stocks are a lot more safe investment, and while it can look very good from this side of things, things can also turn down very, very quickly for growth stocks when things inevitably do turn down. Number 3, dividend stocks provide guaranteed returns through cash flow, while growth stocks only make money from share price appreciation. While we go back to this chart, let's go ahead and look at Facebook for an example. Facebook has had very fast share price growth. They went from about a $90 stock up to $250 over the last 5 years. Now, they've not paid any dividends. If their share price went down, or you sold for a loss, like right here in 2018 or early in 2020, if you sold for a loss, then you made $0. Now with Coca-Cola, for example, if you invested in Coca-Cola, no matter what, see these little letter D's right here, and it shows the dollar amounts, that's how much you're getting paid per share each quarter that you own them. You get 33 cents, 35. So let's say you own 10 shares of this. Let's say you have $480 invested. You get $3.30, $3.50, $3.70, $3.90, $4, $4.10. You get the point. You're getting cash flow as you get more and more invested in the stock. Now, number 5 is something that is really important here, as well as number 6. Dividend investing is most successful in bear markets and least successful in bull markets, while on the flip side, growth investing is least successful in bear markets and most successful in bull markets. Now, like I said, remember when I said Coca-Cola doesn't really rise a whole lot in the long run? It's pretty much just a gradual slope upwards. Well, when downturns happen, it doesn't get hit nearly as hard as a lot of other growth stocks. Procter & Gamble is a prime example of this. This is the stock just barely trending up, and this is when the recession happened at the beginning of the year. Only went down about 15 or so percent. Now, when we look at other stocks, like the stock I gave with Tesla, for example, Tesla stock went down a massive amount. When we look at Tesla stock, it was, like I said, $180 a share, and it went down to 70. So when we think about it, went from 180 down to 70, you're literally looking at a stock going down 60, 70%. That is a massive downturn. You might be a lot more prone to sell if a stock goes down that much. But growth investing is least successful in bear markets because you're only relying on share price gains, while dividend investing, you're getting much higher yields when things go down. So investing in the long run is much better in bear markets with dividend investing and much more successful in bull markets with growth investing. Number 7 and number 8, the last 2 points that I have, dividend stocks are usually blue chip household names which are easy to understand. Coca-Cola, McDonald's, Walmart. I'm sure the three that I just mentioned, Coca-Cola, McDonald's, and Walmart, are three stocks that you have seen their businesses day in and day out. You've probably ate a McDonald's before. You've probably drank a beverage by Coca-Cola. You've probably shopped at Walmart or heard of Walmart at least once in your life. Now, these growth stocks are a little bit more difficult to understand. You can probably get a pretty basic idea of these three companies, and these three on the bottom, Tesla, Nvidia, and Snowflake, are probably a little bit more complicated to understand. Now, Tesla is a stock that produces electric cars. They're working on a lot of AI intelligence for their vehicles. They're working on autopilot and self-driving. They're making solar panels. They're working on a number of different models of vehicles. They're also building gigafactories. They're expanding into a number of different countries and expanding internationally. You get the point. And Nvidia does a number of things. I only know a very basic amount about this company. They make microchips. They provide a lot of gaming solutions for a lot of pro gamers. They also provide a lot of microchips for a lot of the big companies out there, a lot of tech companies out there. Nvidia also works a lot with artificial intelligence. And overall, their business model is just a lot more harder to understand than that of a Coca-Cola or a McDonald's. So usually, once again, number 7 is the reason why I say a lot of beginner investors should probably start off with a lot of blue chip companies if you're investing in individual stocks, and try to stay away or at least be a little bit more conservative with investing in the high growth names like Tesla, Nvidia, Snowflake, whatever. But overall, guys, that pretty much wraps it up. Now go out there and start investing. If you're wanting to get started investing, there's never a better time to invest. The earlier you get started, the better you can understand the ideas and the works behind the stock market, and you can start gaining that knowledge. And once again, one of the reasons why it's so important to get started right now rather than wait until later is that right now for the month of September, M1 Finance is getting you $20 bill just for signing up. So if you want to throw in $100, you can get $20 signing up, and then you don't even have to keep the platform if you don't want to. But go ahead and deposit $100, get that referral money, help support me and my channel, and hopefully you can get your charts to start looking like this with your annual and monthly dividend income. Thank you guys so much for watching if you made it all the way to the end. If you have any questions for me, go ahead and leave them down below. But thank you guys so much, and I will see you guys next time.